Last week we looked at time value of money. We were looking at capital budgeting. That was the key. So remember, capital budgeting is looking at allocating funds to different projects. Capital is limited, so companies need to allocate that to different projects. And obviously the best projects are going to be accepted, the projects that give the most value or the most return. So we're looking now at these discounted cash flow techniques. Okay, discounted cash flow means take things back in time. Take things to time 0 and calculate what things are worth in today's terms. Okay, now. Right, not future, but today. Okay, so we're looking at time value of money applied to capital budgeting, right, which is your net present value, your IRR, those calculations. Right, you'll see in this particular chapter, they talk about those calculations in terms of discounting future cash flows back in time. So that's the focus here in study unit 21. You're literally looking at the other measures of value that take time value of money into consideration. Okay, because remember, if we're looking at making a decision, are we going to make a decision based on what we like? So I like this project, or I like that project, or are we going to make decisions based on measurements? In other words, this project is going to be accepted because this project is going to increase our value by 10, or this project will increase our value by 5. Okay, what are we going to do? Are we going to do measurements or calculations, or are we just going to choose because we like projects?
No, we're going to do measurement and calculations.
Yeah, you have to measure things. Okay, because remember, as a financial manager, it's your responsibility to account for all the costs and to account for the value or the projects that are going to be accepted. Right, so that's study unit 21. It's looking at those traditional methods of discounting future cash flows back in time. Timing is important. You have to draw a timeline. You need to show all the cash flows on a timeline because you're going to be moving them forward or backwards, while in this case you'll be moving it backwards. Right, remember time value of money, you can take things to any point in time. You can take stuff back, you can take stuff forward. It doesn't matter where you take it, as long as you're applying the correct concepts, then it would give you a measure of value.
Yes.
So the first one is net present value. What is net present value? It's this. Net present value equals. Okay, so net present value is the present value of your future cash flows, okay, minus your initial investment. That's what net present value is. So with net present value, you're literally looking at what are things worth in today's terms if I take everything in the future back in time. Right, so we'll have a timeline with different points in time. So time 1, time 2, time 3, time 4, time 5, into the future. Okay, with net present value, what you're doing is you're taking things back in time. You're taking all these amounts back in time. You're taking time 1 back in time. You're taking time 2 back in time. You're taking time 3 back in time. You're taking time 4 back in time. 5 back in time. Okay, you're taking everything back in time, and you're trying to work out what the total is in terms of the present value of the future cash flows. Okay, so what I'm taking back there is going to be the total. Okay, so this gives you PV, I'm just going to write down PV1 plus PV2 plus PV3 plus PV4 plus PV5 gives you the total present value of your future cash flows. Okay, and then you less the INV, initial investment, and that equals the net present value. Okay, so that's what you do. So that's how you get net present value. It's take all of this stuff back. Okay, take those future cash flows back. get one amount that represents the present value of the future cash flows less the initial investment, and that's going to give you the net present value. Do you want net present value to be positive or negative?
You want it to be positive, sir.
Exactly, you want it to be positive. Positive means what? Well, positive means all of these amounts, if I take all of them back in time, in today's terms, in other words, T0,
Yes.
in today's terms, those future cash flows are worth more today than the initial investment. So am I creating value?
Yes, sir.
Yes, I am. Okay, that's why NPV greater than 0 is good.
Less than 0, it's rejected.
Yeah, acceptable project or investment. Okay, that's what you're basically doing in finance. You're trying to evaluate a project based on what you expect will arise in the future, based on how much it's going to cost you in today's terms. Okay, because remember, we covered a chapter where initial investment is looking at capital that's financed, okay, brackets debt / equity. Okay, and we could work out the WACC. Right, so WACC is the cost of acquiring finance to accept projects. Okay, so before we were looking at the costs, right, if you want, let's use the example we spoke about from one of those previous chapters that you were asking about, chapter 20. You're asking about the break-even year. Okay, so obviously if I'm breaking even, that's payback period, so I'm looking at that 10 million. So if I'm going to raise 10 million, 10 million is going to come from either debt or equity. I'm either going to take out a loan, or I'm going to ask investors for money. Okay, and if investors are going to invest in our business, they're going to want a return, they're going to want a dividend. If I take out a loan, the bank is going to want interest. Okay, so it doesn't matter where I get the capital from, there's going to be a cost of getting capital. Does that make sense?
Yes, sir.
Okay, so that's going to be the weighted average cost. If I use more debt, I'll have a bigger cost of debt, and if I use more equity, I'll have a bigger cost of equity. So obviously you're going to work out a weighting, and that's going to tell you, well, this is what I expect us to pay for the capital. So if I want capital of 10 million, okay, raised through debt and equity, and the WACC is, let's say, 15%. Okay, what does that say? That says if I'm going to accept this project, okay, meaning if I'm going to invest 10 million and I need to find it, I need to get that 10 million from somewhere. It's going to come from debt or equity, okay, and then I'm going to obviously use that 10, so, or how much did I say? Yeah, use the 10 million, okay, and I'm going to invest that 10, and I'm going to see some sort of benefit. So these would be cash flows. Right, so if we take 10 million and we invest it in a project, okay, what are we going to get in year 1? What are we going to get in year 2? What are we going to get in year 3, year 4, year 5, year 6, year 7, and so on? Okay, and that's what you're looking at here in terms of the benefit. Right, but now I can't evaluate, let's say, cash flows at time 1 compared to cash flows at time 0, because things are at a different point in time. Does it make sense?
Yes, sir.
Okay, so what we need to do is take everything to one point in time. So if I take all these future cash flows back in time, I'm then going to get a value in today's terms. Okay, so let's say the project gives yearly cash flows of, let's just say 5 million. Okay, so obviously I get 5 in the 1 year, 5 in the next year. That means after 2 years I've already paid the 10. Do you agree? But that's payback period.
Yes, sir.
Okay, that's not net present value, because net present value is taking time value of money into consideration.
Yes.
Okay, so if I'm getting 5 every single year, okay, obviously payback period would be 2 years. Okay, that's very quick. So that means if you had to take out 10 million today, and if you had to invest it in this project's going to pay back after 2 years. That's really good.
Yes, sir.
Okay, but now we're looking at, well, what is the net present value? Okay, so if we take all the future cash flows back to time 0, how much value are we creating? Okay, that's what you're looking at. And that's what we're looking at here in terms of net present value. Right, you're taking future cash flows back in time. You're doing the discounting. Okay, you're doing all of that. You're taking everything in the future back in time, and you're doing this calculation. Okay, there's it there. Right, so this is what we're actually looking at. Net present value, take all the future cash flows back in time, and get an amount. Get one amount that represents it. Alright, so it's either going to be more or less than the initial investment. Obviously, the bigger it is, the better. Right, see, that's theory. That's what the textbook is going to tell you in this chapter. Happy with the theory?
Yes, sir.
Okay, so now we need to look at the examples. Right, obviously, do you need formulas?
No, sir.
No, you don't. Why? Because you're going to use the financial calculator.
Yes, sir.
So practice using it. As long as you've identified the correct variables, it's easy to calculate NPV using the financial calculator. It's quicker, it's simpler, and it's also more accurate as well. Right, there's nothing wrong with using equations, but it just takes a lot longer, and it's a lot more mathematics.
Yes, sir.
Okay, they talk about advantages here. So why is NPV better than all the other measures? So why is it better than payback period? Why is it better than the average return? Well, the first thing is it takes time value of money into consideration. And that's a big thing. Okay, because we know that money today is worth more than money in the future, right?
Yes, sir.
Okay, so that's the first advantage. It also looks at the whole project. Okay, remember with payback period, it just looks at, well, when do you pay back the initial investment? It doesn't look at the rest of the project.
Yes, sir.
Okay, you can also adjust for risk. So if you're unsure about how much the project is going to reap as a benefit, then you can provide for that in your calculation, okay, in terms of risk. Right, you can add a premium to the actual discount rate to make the project provide for more or less risk. So if the project is very risky, I'm going to use a higher discount rate. If the project is not as risky, I might adjust the rate depending. And we can also assume that the cash flows can be reinvested. That's also important, because think about reinvesting. What does reinvesting mean? Well, where's the diagram here? Okay, so if I get an amount in year 1, am I going to reinvest that?
Yes, sir. Yes.
Yes, you can. Right, so if you get something in year 1, you can put that elsewhere. You can invest it elsewhere. Does that make sense?
Yes, sir.
Okay, so if the project is making money, okay, in terms of generating some sort of benefits, that benefit can be reinvested. And that's what net present value assumes. Net present value assumes that the cash flow that you get is reinvested. Right, so that's why it's a much better measure. It is the best measure of value that a project is creating. Okay,
yes,
net
sir.
present value is used the most out of all the different measures. Okay, yes, the other measures are also used, but the one that counts the most is net present value. Okay, disadvantages. Well, WACC is difficult to understand. Okay, because remember, WACC is going to be based on your capital budgeting. Okay, or your capital structure. Okay, so obviously different companies have different views. Okay, some might use more debt, some might use more equity, depending on their risk profile. Okay, so companies that are more aggressive would use more debt. Companies that are more conservative would use more equity. Something else, calculation of WACC is complex and subject to interpretation. Okay, remember, nothing is set in stone. It's just someone's view. It's someone's opinion. Okay, no one can predict what's going to happen in the future, but you can have a view. Okay, so you think this will happen. You think that will happen. Right, it's subject to interpretation. So there could be some bias in the calculation. It's possible. Right, the risk premium or discount is added to the WACC can be manipulated by management. Okay, because remember, who makes the decisions? Management. So if management has a very negative view, they would view things very negatively. So they might say, well, let's add risk to this particular calculation, or let's not add risk to this calculation, depending. Okay, so again, it's looking at bias. Right, calculations can be manipulated to some extent, in order to provide a specific view, okay, or to get a specific decision. Right, the result of the discounted cash flows is a rand amount, okay, rather than a rate. Right, so if I'm looking at a rand amount, it is a little bit more difficult to accept or reject because it's rands, okay, rather than a percentage, like a yield. Okay, so that's why IRR is also used when deciding on whether a project is good or bad. Okay, then they talk about evaluation criteria. This is important. Okay, you know this from DSC. If NPV is positive, we're going to accept. If it's negative, we're going to reject. If it's 0, well then you could actually accept or reject, depending. Right? It just says that you've received a return that's equal to your cost. Okay, so the internal rate of return is the same as your cost, basically. It's how can I put it? It's basically saying that if I discount all my future cash flows back in time, it equals the initial investment. That's why I have a 0 NPV.
Yes, sir.
Okay. If projects are mutually exclusive, okay, we spoke about independent and mutually exclusive projects. If something is mutually exclusive, can I accept more than one?
Sorry, sir?
If a project is mutually exclusive, can I accept more than one?
Yes, sir.
No, I can't. Projects must be independent.
Oh, independent. Sorry.
Okay, remember there was independent and mutually exclusive. Let's go back. There. Independent projects are standalone. Can I accept more than one?
Yes.
Yes, I can. Mutually exclusive, the one depends on the other. Okay, so if I choose project A, project B falls away. If I choose project B, project A falls away. That's mutually exclusive. Only one can be chosen. Independent, I can choose more than one. So I can choose project A and I can choose project B. Got that?
Yes, sir.
Okay. Right, so let's look at an example here. Okay, so here you go. You've got 3 projects, Y, T, and P. Was that it? Yeah, that's it. Okay, so you've only got 3 years. That's easy to calculate, right? Okay, how much is this project going to cost?
100,000.
Correct. So Y0 is minus 100. Do you agree?
Yes, sir.
Okay, and then you've got cash flows of 50, 50, 25 for the first, 60, 50, 40 for the second, and the last project 20, 40, 80. Those are cash flows. Right, assume a required rate of return of 14%. Okay, so your I is 14%. Okay, so grab your financial calculator, work out NPV. I want NPV for Y, T, and P. What do you get?
Okay, I'll do for Y first. 50,000, 25,000 for year 2. 14% is my rate, and then the second function NPV. For the first year, I got 792. Well, negative 792.68654.
Let's check. Where is Y? First project's Y, hey?
Yes, sir.
This one, 825.
I got 792. Well, let me try it again, but I got 7.
Let me do it on my calculator as well. Okay, so you're using the cash button. The rate
Yes.
is 14%. You're starting with negative 100,000.
Yes,
Okay,
sir.
first cash
Sir.
flow is 50, positive, then 20, then 25. Okay,
No, so the
same
next one is
NPV.
50, sir.
I get, was it 14%? Yeah, it was 14%. This was for Y. This was 100,000. Hey, let's just check. Yeah, minus 100,000. Then you've got 50. You've got 50. Oh, 50, 50, 25. Sorry, what do I put in?
Yes, sir.
I put 50,
You
20.
put
No,
20.
that's wrong. 50, 50, 50, 50, 25. Okay, that's better. Escape, solve. What is NPV? Yeah, 792. I also get that.
Yes, sir.
Okay, remember, they're using this. They're using the present value of the factors.
Okay.
Okay, so they're using a table to work it out. That's what they're doing here to get the discounted amount. That's why their net present value is a bit different. Okay, the more correct answer is 792,68 ... Okay, let's just see if they do give the calculator there. Financial calculator. There we go. See that?
Yes, yes,
Financial
sir.
calculator. Where is Y?
But I think when I looked at it, it looked like they'd split each project. They worked it out differently. So when I saw the one for the financial calculator, I think it was for the second project and not the third, not the first one.
Oh, for the second project, not the first one.
That's what I saw. I'm not sure.
Project T. Okay, so T is working out. I just want to see if they give the financial calculator for Y. No, they don't. Okay, so they didn't do Y in the financial calculator. They obviously use different measures. Okay, so let's look at this one. Project T. Project T using tables and financial calculator. Okay, obviously financial calculator is the right way to do it.
Yes, sir.
Okay, so let's do T. Okay, this one. Okay, so grab a financial calculator. Cash mode. 14%. 100,000 initial investment. 60 here. 50 here. 40 here. What do you get?
18 point. No. This is 18,103.8160,190.
Let's see. Okay, there. Financial calculator. 18,103,81602. Okay,
Yes,
they're
sir.
still using the present value factors here. See? Okay. But here they should have used it. Yeah, there we go. That's better. There you go. Sharp and HP. So you did it this way.
Yes,
Best
sir.
answer. See, that's perfect. That's accurate. You see that?
Yes, sir.
Okay, so this is how you're going to do time value of money in net present value, NPV, on the financial calculator. You're going to use the financial calculator.
Yes, sir.
Okay, so that's the right answer. Don't use tables, because you can see tables give me a different answer. It gives me that. Okay, this is accurate. This is as accurate as you're going to get. You can't get a more accurate answer than that.
Yes, sir.
Okay, you can also use Excel to do it. Okay, they've used P. P they've used using Excel. Excel should also give you an accurate answer. So Microsoft Excel, see, they've done it here like this, and they got NPV of that. Okay, this might have been rounded off, okay, to the nearest rand. Right, so let's do it on our financial calculator. Okay, so put that into your financial calculator.
Yes, sir.
You'll see you should get the same answer, rounded to the nearest rand.
I just did it now. Yeah, it's they rounded it off to the nearest rand, because after
2320,28.
Yeah.
Perfect. Yeah. See, so if you use Excel or if you use the financial calculator, you're going to be accurate.
Yes.
You're going to be very accurate, and that's why you always use that. You don't use funny tables and formulas and all of that. You use your financial calculator, because that's the most accurate answer that you're ever going to get.
Yes, sir.
Okay. Happy with that?
Yes, sir.
Right. What else was given in this chapter? Was that it, or was there more? Oh, yes, there was more. Okay, internal rate of return. Right, what is IRR?
Initial rate of return. IRR, internal rate of returns.
Yeah, but describe it to me. Don't just give me the acronym.
Oh, sorry.
What is it saying?
I'm actually not too sure. What is?
Okay, what did we say earlier about net present value? What does net present value do?
Net present value figures out I want to say well, it takes everything back in time so that we can understand the value of the project which we are doing.
Okay, exactly. So net present value takes cash flows back in time. Do you agree?
Yes, sir.
And what do you insert? You insert a rate. Do you agree? So net
Yes,
present
sir.
value, you insert a rate to discount cash flows. Does that make sense?
Yes, sir.
Okay, with net present value, you're inserting the rate. With IRR, okay, with IRR, you're not inserting a rate, you're calculating the rate. So with IRR, this is the rate that gives NPV equals 0. Okay, what does that mean? This says that the present value of your future cash flows equal your initial investment, your INV. Okay, that's what you're actually doing. Okay, because the formula was this. Net present value equals present value of your future cash flows minus initial investment. Okay, so using IRR, okay, your net present value will be 0. NPV would equal 0, meaning that present value of your future cash flows equal your initial investment. That's what you're saying. Right, that's what IRR does. IRR is basically looking at the internal rate, meaning if I've got 10 million here and I've got cash flows there, they're saying, well, what's the internal rate? Internal rate meaning how much does this 10 million actually make that makes this cash flow in the future equal to that at the beginning? Right, so in other words, IRR is the rate that is applicable to the investment over the time period. Okay, so IRR is basically a measure of what is the internal rate over here, over that period. Okay, that's what IRR is looking at. IRR is looking at the internal rate of those cash flows in relation to the initial investments. Does that make sense?
Yes, sir.
Okay, so that's what you're trying to calculate when you're looking at initial rate of return. Okay, you can't do initial rate of return manually. It's a repetitive process. It's called Newton's method. Right, so I doubt they would have given you Newton's method here. Okay, they talk about advantages. Obviously, if I look at IRR, same things apply. Time value of money taken into consideration, cash flows of the entire project are taken into consideration. IRR looks at the maximum rate, okay? It's a discounted rate, it's a percentage. It's very popular in the business world. Why? Because it's a percentages. Okay, percentages are always talking about in decision making. Okay, so 10%, 5%, 20%, all of that. And that's why it's a nice way of making decisions, because you've actually got rates and then you can compare that to WACC. Because remember, WACC is also a rate. Okay, WACC is given as a percentage of cost. Do you agree?
Yes, sir.
Okay, then disadvantages. It assumes that surplus cash is reinvested, which can be unrealistic. Sometimes you don't always reinvest your cash flows. Sometimes the cash flows aren't reinvested, and if it isn't reinvested, then the calculation will be inaccurate. Okay, it might be inconsistent with net present value depending on what projects you have. Alright, so in the case of mutually exclusive projects, if I choose one project, the other project is eliminated. Do you agree?
Yes, sir.
Okay, and that has an impact on the decision making. In terms of valuation, IRR must be greater than the WACC. And that makes sense, okay, because IRR is the return. And if the return is greater than the WACC, which is the cost, you would accept the project. Do you agree?
Yes, sir.
Okay, if it's the opposite, you would reject the project. If IRR is less than, then you would reject. Make sense?
Yes, sir.
Okay, and that's the criteria for IRR. Okay, so let's go back and look at these projects. Okay, so here, evaluate the above three projects by calculating their IRRs. Project Y by using the financial calculator. Okay, so there we go. We're going to use the financial calculator. Did they give the cash flows here? Okay, no, we have to go all the way back. Okay, so go back to this page. Where is it?
117.
Yes, okay. That page. And work out IRR of Y. Use your
So
calculator.
everything still stays the same.
Using the calculator.
And then so we're trying to work out second function IRR.
Yeah, second function IR. So you don't put in a rate, eh?
Yes, sir.
Okay, what do you get?
Okay. Well, for Y I got 13.4765422104.
Okay, let's go back and check this.
So for 30,
where's the
13.48%.
Okay, we've done that. Okay, there's R. Okay, there we go. This is where we are. Let's check. Yeah, 13.47.
13.4765422104.
Yeah, there you go. Either using Sharp or the HP. That's good.
Yes.
Easy, hey?
Yes, sir.
Okay. Alright, let's have a look at some more examples. Are there more here? Okay, so obviously they're showing you other ways of doing it. You can use the financial calculator. You can use Excel. You can use, interpolation. Okay, interpolation is a way to estimate, okay, the internal rate of return. Right, it's not a very accurate way of doing it because the more accurate way of doing it is Newton's method. Newton's method.
Yes, sir.
Right, that's a repetitive process to get that's what the calculator actually does. The calculator looks at Newton, okay, and it calculates what the actual rate is that makes it zero. Okay, it's a repetitive process. Right, if you don't have Newton's method, then you would use interpolation. You would then try estimate what the rate is. Okay, but that's not accurate. Accurate is use the financial calculator. Right, then you've got one more here, profitability index. Profitability index is looking at a relationship between your present value of your future cash flows. So let's take this and the initial investment. That's what you're looking at. Okay, you know from DSC they gave you another formula that didn't look like this. The other formula that you're familiar with from DSC is open brackets, NPV plus INV, close brackets, divided by INV. Okay, that's what you're probably familiar with from DSC. Okay, and the reason why I've got that is because of this. Have a look. Okay, net present value equals that, right? So can I rearrange the equation? Yes, I can. Make PV of the FCFs the subject. Okay, so if I rearrange, what am I going to have? I'm going to have present value of your future cash flows equal to your net present value plus your initial investment. Does that make sense?
Yes, sir.
Do you see the maths?
Yes, yes.
Okay, so what I have here, this is the same as that. Yeah, does that make sense?
Yes, sir.
Okay, so net present value plus INV, okay, equals present value of the future cash flows. It's exactly the same. Right, so it doesn't matter what formula you use. You can use this one. I would actually use this one. Why? Because NPV I can calculate on my calculator, right?
Yes, sir.
Okay, so this is actually a quicker way of getting the right answer because I can calculate all of this on my calculator. NPV I can work on my calculator. Initial investment should be given in the question.
Yes.
Okay, do you want profitability index to be greater than 1 or 0 or less than 1?
You want it to be greater than 1.
Correct. Greater than 1 is good because that says that the numerator is bigger than the denominator. So value is being created. Right. So you would definitely want a present value index, a profitability index to be greater than 1. Okay, so let's look at an example. Do they give you one? Evaluate the 3 projects by calculating the profitability. Okay, so you're going to have to go back to that page again. Do they give that table here? No, they don't. Okay, what page are we on here? 143. Let's go back to that other page. 120, I think, round about there.
117.
117. Okay, a bit further on. There's it. Okay, so let's look at the profitability index. Profitability index, let's just use T for now. Okay, what would the profitability index be for T? Okay, we can use this formula. You're going to get the same thing.
NPV. Okay. So the NPV for it was 18. Should I put in the whole value or should I round it off, sir?
Put in the whole value. Be accurate.
Okay. Just look for it. So 18103.8160 plus by the investment. The investment was 100,000 divided by the investment, which was 100,000, which equals 1.18103.816.
Let's check. Where are the answers? 143. I am on the right page, am I? Oh, here's it, yeah. What did you get for T?
For T, I got 1.18.
Yeah, 1.18 is correct.
1.103816.
Yeah. See, that's right. See?
Yes.
Okay, so you can use net present value plus initial investment over initial investment for profitability index. Makes sense?
Yes, sir.
Great. Right, that covers that chapter. That's the summary, and then they give you a question here. I think let's do one question just to make sure that that makes sense. And I think that wraps up that chapter. Let's just double check. It's at the end. Yeah, it looks like it. These are all additional workings, questions. Okay, yeah, comprehensive self-assessment activity. This gives you all the different cash flows. Looking at the measures, payback period. Is that it? Yeah, it looks like it. Okay, yeah, that is it. So let's do this last question. I like this question because it's a comprehensive one. So that means it will cover everything. Where does it start? Here's it. It starts here. Okay, do you see it? This is page, what? 144.
Okay, sir. I'm there.
So let's do one example. I'm just going to move this aside so you can see the workings. Okay, so the question says, Alpha Limited, the budgeted committee of the company is faced. Okay, let's put a heading here. Page 144. Comprehensive example. Okay, so a little bit of revision as well. Okay, so last week we did payback period. I think it was the first one. Where's the payback period? Ooh, too far. Payback period. There we go. Payback period. Okay, so we need to start with number 1. They're probably going to ask for it, and then let's go for number 2. Number 2 was this one. Okay, 3 is obviously net present value, and 4 is obviously IRR. Okay, and then obviously payback, not payback, profitability index, 5. Okay, so those are the measures that you're going to need when making decisions, okay, when determining if a project is good or bad. Do you agree?
Yes, sir.
Okay, so let's read the question. What else do they say? Okay, they said the budget committee of the company is faced with a choice between 2 machines. Okay, so we're either going to go with A or we're going to go with B. Okay, either this one or that one. The cost price, it's given, 1 million and 1.5. Okay, so obviously A is cheaper than B. Residual value means what is the asset worth at the end of its useful life? Does that make sense?
Yes, sir.
Okay, annual income. See, there's cash flow. That's NB. That's a cash flow. Right, the cost is going to be seen as your initial investment. Okay, required working capital. Required working capital is what you need in order to keep operating. Okay, so that would have been part of the requirements in terms of capital budgeting. Okay, this is how much we need every year to keep running. Expected useful life, 10 years, 10 years. Okay, so the same useful life. Then they said the company can invest all its funds at a rate of 12% per annum. Okay, that's important. That's a rate. That's the investment rate, which is also regarded as acceptable return. See, that's important. Why? I'll use it for NPV. Okay, that's my discount rate. The accounting policy of the company is to provide for depreciation on a straight line method. Do I look at depreciation in finance?
Didn't we do it for cash flows? But we do it for taxation purposes. So
yes.
I think to take it off.
Good. Yeah, you take it off because it's a tax saving. SARS allows a wear and tear. That's what they're telling you. See, they're telling you the tax saving. All right, that's it. Okay, apply the following methods to evaluate the 2 mutually exclusive options. If it's mutually exclusive, how many can I accept?
1.
Only 1. Okay, and then comment on each. Okay, fine. So 1, 2, 3, 4, 5. Okay, so we've put the order a little bit different. Okay, because I'm just following the textbook. They gave you payback period as 1, so that's my 1. They gave this as my 2. They gave this as my 3. They gave that as my 4, and they gave that as my 5. Okay, but we had all of them. Do you agree?
Yes, sir.
Okay, so the first step is to obviously get the timeline. So when doing a question like this, it doesn't matter what the question is. NB gets the timeline. You can't do this question if you don't have a timeline.
Yes.
Does that make sense?
Yes, sir.
Okay, so let's draw the timeline. Okay, let me do this on the right here. I'll do the workings here. Okay, just so you can see everything. Okay. Alright, so how many years do we have?
10 years.
10 years, exactly. So we've got 2 different projects. We've got project or machine, doesn't matter what they call it, machine A, machine B. Okay, so T0, T1, T2, T3, T4, ... T10. Okay, same thing for B. Right, what did they say in the question? Did they give you the cost price?
Yes, so they did.
Yes, they did. So that's my initial investment. So I'm going to need, what is it, 1 million? Yeah, 1 million from, 1 million for A. Okay, and 1 million for B. 1.5. Okay, negative. That's the initial investment, right? Do you agree?
Yes, sir.
Okay. Right, what else did they say in the question?
Well, there was depreciation. Yes.
What is the residual value telling you? It's telling you how much the asset is worth when.
At the end of the period.
At the end of its useful life, correct. So at the end of machine A's life, how much can I sell it for?
110,000.
Exactly. And B?
160,000.
There you go. Okay, so there's my residual value. Okay, what is the next line item?
Your annual income after depreciation.
Okay, annual income after depreciation. Okay, this one's a bit tricky because remember, they said this is after depreciation and income tax. Do you agree?
Yes, sir. Yes, sir.
Okay, so you're getting 152, which is annual income, and that annual income is coming from project A. Okay, well, machine A. Do you agree?
Yes, sir.
Okay, what is the depreciation going to do?
Well, the depreciation you have to take it off so that, well, for taxation
when you
purposes.
Say take it off, what are you meaning?
It comes into your payment of.
Are you going to add it back or are you going to minus it? That's what I'm asking you.
Oh, you're going to minus it, sir?
No, you're not going to. Well, if you think about it, depreciation, can you claim it?
No, sir.
Yes, you can. You claim it as a wear and tear allowance.
Yes.
So, are these cash flows after or before depreciation?
These cash flows, they are after depreciation.
They're after depreciation. Is depreciation a cash flow?
No, sir.
No, it's not. So what must I do? You
should remove it.
No. Well, remove means add it back.
Well, okay.
Add back non-cash items. Okay, remember we spoke about non-cash items not affecting cash flow?
Yes, sir.
Okay, so if I add back the non-cash items, I need to work out how much do I actually have of the depreciation. Does that make sense? How much was the depreciation here? We need to work it out.
Yes.
They gave you the cost price of the asset, they gave you the residual value. Okay, so depreciation will be the difference divided by 10 years. Okay, so depreciation for asset A would be its cost, which was a million, minus the residual value, close brackets, divided by 10. Okay, because 10 years. So that gives you depreciation of how much a year? Let's check. 1 million minus 110, close brackets, divide by 10.
89.
Gives you 89,000. Correct. So my cash flows here are actually going to be this plus that gives you that amount. Is that right?
Yes, sir.
Okay. Ooh, it's not copying the right amount. Okay, that amount, that amount, that amount, that amount, that amount, that amount. Okay, what else did the question say? Let's go back and see. What was it? Yeah, that was it. So they said that residual value at the end of useful life was 110, and they told you what the cost price was, and they gave you the expected useful life. That's it. So that's your after-tax cost of the actual asset. So that's looking at your annual cash flow. Does that make sense?
Yes, sir.
Okay. That was for A. We need to do the same thing for B. Okay, so what was B's cash flow? Let's check. B's cash flow was 183.
Yes, 183.
Right? Do you agree?
Yes, sir.
And then what must we do? Add back non-cash items. This asset cost 1.5. What is its residual value?
160,000.
160 divided by 10 years still. Okay, so 1.5 minus 160 divided by 10 gives you 134. Okay, so every year I'm going to get 317 cash flow.
134,000. Yes.
Does it make sense?
Yes, it's making sense so far.
Okay, so do you have all your cash flows now?
Yes, sir.
Yes, you do. You've got your initial investment. You've got all your cash flows. Okay. Can I work out the NPV and IRR?
Yes, sir.
Yes. NPV equals payback period equals IRR equals ARR equals. Okay, so grab the calculator, work it out. I'm going to try use Excel and just see what I get. Okay, the ratio. What is my ratio? Go back to the question. Just read the question. What is the rate?
12%, sir.
12%, eh? Okay.
Yes, sir.
0.12. Okay. First value is this. Next value would be
Okay.
that.
So I'm working out for machine A so far.
3, 4. Yeah, for A. 5,
Okay.
6, 7, 8, 9, 10. Okay, in the last year, I'm going to have to add that other amount as well. So in the last year, it'll be this plus the extra value there, the residual value. Close brackets gives me... Okay, I'm getting that answer.
Can I also ask, since we put 110,000 as our T10, is that the inflow at the end of? Is that the inflow for time T or time 10? Sorry.
The 110. Yeah, that's an inflow. Yeah, that's an inflow for time 10. So inflow for time 10 would be the total, the both added up. This plus that.
Okay, so I did something. Wait. Which is 262. 262. 12% was my I. Second function MPV. For machine A, my NPV was 105,000. 7.
Can't be right. Let's check it.
It's not.
Okay, 12%. Okay, so initial investment minus 1 million. First cash flow is 241. 241 every single year.
Wait, so why is it 2? Oh, no, it is wrong. So it's
241 for 10 years. In the last year,
it is wrong.
In the last year, it's 241 plus 110,000 close brackets gives you 351. Yeah, that's the last year. Escape, solve for NPV. On my financial calculator, I get 397. That's what I'm getting on the financial calculator. Did I use the right amount of years? Let's just check. That's 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. 10 years at 12%. Solve for NPV. What does it come out to? Yeah, 397. Okay, so I don't think the Excel is correct. So let me put in the right amount. 397,120.8059. Did you get that as well?
Yes, sir.
Okay, that's good. Okay, let's just see, what did they get in the question? What did they get in the textbook? Let's see. Okay, so question 4. Here's their working NPV. Okay, so we had that. Oh, do we have that? No, we didn't. Oh, I left out the yeah, I didn't put that in my working. We need to. Okay, I see they've included the working capital there. See that?
Yes, sir.
Okay. What did they say about the working capital? I forgot to include that. Oh, yeah, that's wrong. Okay, there. Required working capital. Forgot to put that in.
Yes, sir.
Okay, so required working capital must be inserted in. So you would then have to change this. Okay, so if I add that, so working capital, net working capital, you'd have minus 180 here. Okay, and then net working capital is returned at the end of the period. So net working capital minus 100, not minus, plus 180 there. Okay, yeah. So we have to add that. So that's something that I've left out in the calculation. We need to include that. It was part of the question. Okay, so they said you require 180 at the beginning.
Yes, sir.
Okay, so we need to change this figure then. Okay, so let me go back to my calculator. My first year is now going to be negative $1 million plus negative 180. So negative 1,180,000.
So your T0 is?
T0 is those two amounts together.
Okay.
Okay, and then I need to change the end amount as well. The end amount would be 351. So it'll be 11000 plus 180 plus 241. Gives you 531. Escape, solve for NPV. What do we get? 275. Let's check. Yes, 275.0. Okay, I get 075. Alright, oh, okay, well, they're using present value factors, so no wonder. Okay, so it will be a bit off because they're using the maths. They're not using the financial calculator. Right, financial calculator, you get 275.075, comma 9885.
As your NPV?
Yes.
Okay.
275.075.9885.
At time T, it's the 110 plus the 241 plus the 180.
Yeah, it's all of those three.
Okay, so.
Okay, now we have to do the same thing for B. B had 220,000 here. IRR for this one, for A, comes out to
okay, 220 plus 5
17.06655.066. Okay, that's your IRR. Payback period. When do I pay back the initial investment? Well, I need to check. So I need to add up these amounts. Right, so if I add up the first year, this plus that, plus that, plus that, plus that, okay, then I pay it back. So that's 5 years. Okay, so can I work it out on my calculator? I think my calculator can work it out. Yeah, it can. Okay, so if I solve for my calculator, I get payback period. $4.8962 ... years. Okay, the annual rate of return, average net profit after tax divided by average investment. Okay, so net profit after tax, I think we had that calculation. Yeah, we had it. Oh, net profit after tax, so we need to take off the tax. Did they give you before or after tax here? Annual income after depreciation and income tax. This was average net profit after tax divided by average investment. Okay, so your average net profit after tax will be start plus end. Did they give you the start? No, they didn't. They didn't say anything else about the start. So you could divide it by 2 then, but then it's divided by, well, it'll be the opening and the closing, which would be exactly the same, yeah, because the amount didn't change, so it would actually be the same amount. Okay, let's just show that. Where is they working for that? Okay, there's the IRR. Okay, 17.07. Okay, there's a little bit off because they were using the formula. If they use the financial calculator, profitability index, we also need to calculate. We'll do that just now. Where's the ARR? Here's the ARR. Okay, so the original investment. The original investment, that's what we had that. Residual value, depreciable value, residual income, average investment value. Okay, that was the average investment value. The annual profit after tax, we worked that out. So it was the 152. Yeah, there's the 152. That was given. Okay, so that was given. So you just had to work out. The average investment. Okay, so the average investment would have been. Well, originally I had 1 million investing 110,000. Okay, gives you that amount. Average value, obviously, okay, they're dividing it by 2. And then they're adding the residual value, which is what you have at the end. Because this is net profit after, no, not net profit after tax, this is the average investment. The average investment. Okay, so the average investment here was the original investment, what I started with, minus the residual value, divided by 2, and then add the residual value. And that gave us the ARR. Okay, let's go back and see what were the other figures. Okay, our payback period was fine, it was 4.89. IR was fine, net present value was... What was net present value? 275, oh, that's fine. Okay, so it's just the ARR that you need to follow their format. Okay, so just follow what they've given you here. NB. See page. What page is this? 148. Okay, you need to follow the ARR calculation here because they gave you the average net profit after tax. That was fine. Okay, it wasn't going to change because think about it. Average net profit after tax, the start was 152.
Yes, sir.
The end was 152. So if I take start plus end and if I divide it by 2, what do I get? I still get 152. 152 plus 152 divided by 2 is still 152.
Yes.
Okay, because the amounts didn't change. The amount stayed the same.
So we should do it like they do it here.
Yeah, follow the ARR just for this calculation when you work out the average investment.
Okay.
Okay, the rest is fine. You can use the calculator for all the others. Payback period you have to probably do manually on your calculator. The HP can't work it out. It doesn't have a function for payback period. So you'd have to work out how much do I have every year. Okay, so after 1 year I have 241. After 2 years I have 482. There's the sum. After 3 years I'll have... undo that. After 3 years I'll have 723. After 4 years I'll have that, 196. See that?
Yes, sir.
Okay, so 964 is what I have after 4 years. So then 5 years, I have 120. 1.2 million. That's too much. Okay, so it's obviously 4 years plus. How much do I have after 4 years? 964. So 964, and how much do I want? I want 118. So 118,000 minus 964, close brackets, divided by, how much do I have in the last year? 241. Okay, that gives you the right answer. Okay, so this bit over there, as a fraction or a decimal, is that 0.8962, yeah. Okay, that's if you had to do it manually. Makes sense?
Yes, sir.
Okay. Right, so that's A. See if you can get B. Work out all B's values. Net present value, payback period, IRR.
Okay.
See what you get. And then we'll check it just now. Okay, so on net present value is going to be calculated using your cash flows, right?
Yes, sir.
Okay, so on your cash flow button, your calculator, I'm still using 12%. Your first amount is going to be negative 1.5 million plus negative 220.
Yes, sir.
Okay, then your second amount is 317. That's 1, 317, 2, 3, 4, 5, 6, 7, 8, 9, and then the last one, it's going to be 317 plus 160 plus 220. Okay, escape, net present value, solve. What do you get? Let's see. What did you get?
I got 193,470.5299.
Correct. That's good.
Yes, sir.
Okay, let's check your payback period. Okay, I'm going to get the calculator to give me the answer. What did you get for payback?
I first did my IRR before I did my.
Alright, let me write down payback first, and then while I've got the answer here, 708 years. Okay, IRR, let me solve for that. Solve. What did you get as IRR?
IRR, I got 14.497978.064.
Okay, yeah, 14.497, yeah, that's right. Okay, so 14.4979.
Yeah, yes, sir.
Okay. Right, and then okay, so this ARR, again, use their formula. So, just to show that again, see? Alright, so ARR is this. Okay, so the average net profit after tax, that's easy. That's the 317. Doesn't change. And then you've got the average investment. That's the tricky bit that you need to get using their formula.
Yes, sir.
Okay, so then use the formula. Original investment minus the residual value gives you the depreciable value. Okay, divide that by 2, add the residual value, gives you that 830. Okay, and then if we take the 830, 830, ooh, hold on, I've used the wrong amount here. I used the 317. It was this amount. It was those amounts, because that was what was given in the question.
Yes, sir.
Okay, not 317. It was 183 was given in the question. 183 plus 183. Okay, divide by 2 is 183. Okay, that's better. Okay, and then obviously 183 divide by 830 times 100 equals 22,04. Yeah, that's right. Okay, so 22,04. Is that alright?
Yes, sir.
Okay. Okay, and that covers this chapter. So I like this example at the end of the textbook because it covered all of them.
Yes, sir.
Okay, and we've looked at machine A, we've looked at machine B. Right, biggest tip I can give you here is, as I said earlier, draw a timeline. If you put everything on the timeline, it's simple, it's easy, you can calculate stuff quite simply.
Yes.
Okay. All right, so let's take a break then, and let's come back, and then we've got theory to look at. Let me just see that at the end of the chapter, just to make sure. Yeah, okay, then we're starting a brand new part. Okay, part 4, risk management. A lot of theory, those are the last few chapters, and then we can start looking at past papers. All right.
Yes, sir.
Great. Okay, so we're looking at part 4 here, which is the risk management part of the module. Remember, with management accounting, you're looking at the strategy, you're looking at the techniques, you're looking at quite a lot in terms of scope in this module, the Mac2602. So the last bit is risk, and it's covering theory relating to risk management. So we'll look at risk theory, approaches to risk management, identification, documentation, assessment, and reporting. Okay, there's a lot of different areas of risk that we need to consider, because remember, risk is something that the business is going to have to deal with in order to maximize return.
Yes,
Topic
sir.
9, risk theory and approaches to risk. That's the first bit. There are 2 chapters in this particular section. You've got risk theory and the approaches, as well as risk management. They talk about the concepts, the objectives, and they look at the different components. That's what they're looking at in the first 2 chapters, and then later on they just wrap up with the identification and the assessment. Okay, just to highlight the first bit, which is the main heading, let's put that in. Okay, this is chapter 22. Risk concepts and objectives. Okay, so the most important thing is, what is risk? That's where we need to start. Okay, so how would you define that concept?
I'd say that risk is it's taking an opportunity or taking a chance. Not 100% sure of I suppose the outcome, but taking the chance in hopes that it will yield a great return.
Okay, that's good. Yeah, so risk is definitely taking a chance, not sure what the outcome is. If we just had to explain it in one word, we could maybe talk about it as being uncertainty.
Yes, sir.
Okay, so something that's uncertain. We don't know what's going to happen, but we know we need to take risks in order to hopefully generate some sort of return. Okay, maximize return. But remember, businesses will be investing in projects / investments, taking risk with the hope of receiving a return. Okay, so we've spoken about risk before when we looked at CAP-M. Okay, when we did CAP-M, we said that risk and return has a direct relationship and it's linear. Do you remember that?
Yes, sir.
Okay, so if I have risk would be on that axis, and then the return would be on that one. And if I'm looking at the relationship between the risk and the return, the relationship would be linear. Okay, so what does that mean? Well, that means if I'm taking on more risk, I would expect a bigger return. You don't always get a bigger return if you take on more risk. Sometimes more risk could lead to more losses as well.
Yeah.
Okay, so the chapter here, or the section here, is looking at risk management. So what is risk management going to focus on then? You know what risk is, so what do you think this is?
Well, being able to control our risk.
Okay, can you control your risk?
Well, I think you can, sir.
Control your risk.
Well, maybe control isn't the wrong word, but I don't want to use manage. That's the thing. But to to be able to assess your risk and to say, almost assess or manage in some way. But
yeah, that's correct. So you said assess. Assess is a good way of looking at it. So do you agree? Yes. You're going to be making decisions, okay, in an environment that is uncertain.
Yes, sir.
Okay, so if you're choosing to invest, you're not going to know what's going to happen. Okay, the investment could pay off, the investment could not pay off. No one knows. Do you agree?
Yes, sir.
So risk management is going to be looking at trying to establish what levels of risk we are comfortable with, and then making or taking action. Okay, so something could be like driving a car. Okay, obviously driving a car carries a certain amount of risk. Do you agree?
Yes, sir.
What would the risk be of driving a car?
Well, could get into an accident.
Being in an accident.
It could be stolen.
Okay, maybe theft or hijacking or something like that. Correct. Okay, so if we're looking at risk management, okay, what could we do to lower the risks of being in an accident?
Well, we could drive within the same in the correct speed limit.
Okay, good. So see, that would be a way to manage the risk because you've assessed the risk as being in an accident.
Yes, sir.
Okay, so the risk management is more the surrounding factors that go into the decision making. Okay, something else could be like wearing a seatbelt.
Yes, sir.
Okay, so you've assessed the risk. It is possible to be in an accident. Okay, we know that driving is uncertain in terms of we don't know what's going to happen in the future.
Yes, sir.
Right, so we can only plan around what we know in terms of statistics. Okay, so we know that a certain number of people are, let's say, in an accident. Okay, that's what insurance companies do. Insurance companies basically work off probability. Okay, because not everyone is in a car accident. Do you agree?
Yes, sir.
Okay, but only a portion of those people that are on the road are actually in accidents. Okay, so with risk management, you're looking at probabilities. It's the stats. Okay, making decisions where you've weighed up the pros versus the cons. Okay, and that's what you need to look at in terms of risk management. You need to assess the risk, you need to identify the risks, you then need to determine, well, are you or aren't you going to do a certain thing? Okay, take a, or let's say act. Okay, make a specific decision. Okay, obviously decisions must be made and consequences will arise. Okay, and risk management is basically looking at, well, if I'm going to be making a decision, can I live with the consequences? Right, that's managing risk. So have you identified all the possible negative effects that could arise, and have you decided on whether or not this is something that you're still willing to do? Okay, so here's an example. If you're driving a vehicle, do you agree? If you're in an accident, okay, you could die. Do you agree?
Yes, sir.
We don't know if we will or won't be in an accident because that's uncertain. Do you agree?
Yes, sir.
But can we manage our risk of not dying? Yes. Okay, we can wear a seatbelt. Okay, so wearing a seatbelt would be a way to reduce the risk of dying.
Yes, sir.
Okay, so depending on your risk profile, you're either going to manage risk more or less depending on how you view risk. Okay, are you a business or a person who's worried about the future? Okay, obviously someone who's more worried about the future wouldn't be as let's say aggressive, or they wouldn't be taking as many risks. Do you agree?
Yes, sir.
Right, so someone who's worried about the future in terms of they're really worried they're going to be in an accident. That type of individual is going to be wearing their seatbelt and driving within the speed limits and making sure they don't overtake recklessly, they follow all the rules of the road and so on. Okay, because that's managing risk. For someone who's slightly more aggressive,
Yes, sir.
for them maybe wearing a seatbelt might not be important. Okay, maybe staying within the speed limit might not be that important. Okay, because they've maybe looked at, well, risk is being late for a meeting perhaps. Okay, so speeding might be an option for someone who's running late versus someone who's not running late. I'm just using like that as an example. Okay, so if you look at risk management,
Yes, sir.
obviously there's certain things that you are comfortable doing and certain things that you aren't comfortable doing. Right, so in this chapter here, they're looking at the concepts. So in other words, what must we consider? Okay, and what is the objective? So what are we trying to achieve? What's the outcome that we're trying to prevent? Or what are things that we're going to try, how can I say, reduce? Okay, what losses do we want to reduce? Right, so the first bit is just introduction. Okay, they describe risk. So this is their definition of risk. In this textbook, they've described risk as the typical dictionary definition of risk is a chance or a possibility of danger, loss, injury, or other adverse consequences. Okay, I don't quite agree with that definition. Why? Because that's making risk very negative. Do you agree? Is risk negative?
Sir. No, it's not all.
No, it's not.
No.
Okay, risk is just uncertainty. That's what it actually is. Okay, so it's a very pessimistic view here in terms of the definition. Okay, because when you do certain things, there's a chance of good things happening and a chance of bad things happening. Do you agree? We don't know what's going to happen. That's the risk. Does that make sense?
Yes, sir. Yes, sir.
Okay, so I don't quite agree with this as being danger, loss, injury, adverse consequences, because that's taking a very negative view. Okay, because if I'm looking at risk, there's an equal chance of something good happening versus something bad happening. Obviously, you want to choose projects or you want to make decisions that have a greater chance of good things happening than bad things happening. Do you agree?
Yes, sir.
Okay, so for example, driving within the speed limit has a greater amount of good things happening than bad things happening, right?
Yes, sir.
Okay, so good things will be not getting any fines, not dying, not getting in an accident. Okay, that could be something that's good versus bad, which would be getting fines. Okay, being in an accident. Right, and obviously, the faster you're driving, the more likely you are to die if you were in an accident. Okay, versus if you were driving slower, perhaps. Okay,
yes, sir.
So risk is just uncertainty. That's the right definition. Here, they've looked at you face risks in life. Okay, identify some of the risks in the picture below. Okay, so here's Bart Simpson. He's obviously skateboarding. Okay, what are some risks that could arise?
Well, he could fall, break an arm.
What else?
Sir? He could somehow maybe be bumped over by a car, perhaps.
Okay, so he might get hit over by a car.
Yes. He could be going too fast and not be able to see. I suppose if he's skateboarding across not an intersection, but perhaps maybe across a robot or something.
Okay, yeah. So you're talking about context. Where is he skateboarding, right?
Yes.
Okay, but would you skateboard looking like this?
Oh no, there's no helmet.
Yeah, there's no helmet, right?
Yeah, so safety.
Yeah, there's no arm guards maybe. Okay, or knee guards. Right, this guy is just skateboarding with no safety gear.
Yes, sir.
Do you agree? So is that a risk?
Yes, that is a risk.
There's a lot of risk. So there's risk that you can control and there's risks that you can't control. So internal versus external. We could look at something that's more controllable versus things that aren't controllable. So can we control the traffic?
No, sir.
No. So if he's skateboarding in the street, okay, there could be cars, it could be a busy road, it could be a quiet road, we don't know. But we can't control it. That's something outside. Okay, what about the ground? Where is he skateboarding? Is it on the tar? Is it on the is it on cement? Is it on the paving? Like, where is he skateboarding? Do you agree?
Yes, sir.
Okay, that's the environment. Okay, and then obviously internal would be, well, he could wear safety gear, right?
Yes, sir.
Okay, so there's a lot of things to consider here. This is just one example of risk in terms of things that can go wrong or things that are good. So good or bad. Okay, I mean, risks could be even like having fun. Don't you agree he's having fun?
Yes, sir.
Okay, so obviously that could be a risk, not having fun. Okay, he looks happy. Okay, he's enjoying it. Okay, enjoying the sport. Right, so here they described it as he might fall, he might injure himself, he might be hit by a car. He's not wearing a helmet. Risks in your own life. Okay, so in your life. So let's relate this to what you do. Okay, so as a photographer, let's talk about risks in that area. What are the risks?
Just generally any risk, or like physical or anything. Well, late payment is or not receiving your money is a possible risk.
Okay,
especially
so
once having it delivered.
A financial risk, right?
Yes, sir.
Yeah, so risks can also be grouped into different categories.
Yes, sir.
Okay, keep going. What else can you get? Other risks in a photographer's life.
Your laptop might get either stolen or it could crash.
Okay, so theft, loss of data, yeah.
Your camera. There's a thing inside called a shutter that when you take a picture, it closes and opens.
Okay, so
that could get broken because it's a mirror. Yes, sir.
Equipment failing, so not working. Yeah. What else?
Well, not being able to deliver. Well, this one's connected to what I said earlier. If your equipment crashes and you're unable to deliver your client's work,
okay. Yeah. So that's not meeting obligations, perhaps. So maybe legal risk.
Yes, sir.
Okay, maybe not meeting your obligation. Yeah.
A risk could be losing clients to other competitors, perhaps.
Okay, so competition, perhaps. So there's a risk there.
Yes. And what are the risks?
What about good things? Like you're focusing a lot on the negatives.
Oh, well.
So if you take a risk, can that risk pay off?
Yes, I could.
It can. So what are some of the more positive risks that would lead to a benefit rather than a negative?
Well, approaching clients with concepts and they accept.
Okay. So
taking on new clients.
Don't you agree? Being creative is risky.
Yes.
Because think about it. If you do something different, it's risky, right?
Yes, sir.
Now so being different is either going to set you apart or it's going to harm your reputation, right?
Yes, sir.
Okay, so you see, that could be something that could have a good or a bad. Okay, so maybe there's a certain way of taking photographs, right? But now you're going to do it differently, okay? And by doing it differently, that sets you apart from all the other photographers. But at the same time, it could open you up to risk. Meaning it could be something totally like bad or not good in terms of like maybe it's so unconventional that no one likes it, or it could be so unconventional that everybody likes it.
Yes, sir.
Okay, that's risk in terms of the good or the bad.
Yes.
Okay, what else? Anything else?
Yeah, I suppose you could get new clients as well.
Okay.
And there's also but then said when you talk of the good, would you still call it risk, or would you call it opportunity?
Well, remember, risk is the uncertainty of the event or outcome occurring. So no one knows what's going to happen. So, for example, if you had to approach, let's say you wanted to take photographs of a celebrity.
Yes, sir.
Okay. So if you went and you, let's say, approach them to take photographs for an event that they're having, perhaps, or just like to pitch your service or to offer your service. Okay, do you
Yes,
agree
sir.
the risk could be, well, you might have to do it for free, but
Yes,
the
sir.
opportunity could be, well, you could impress the celebrity so much that you become important to them in terms of taking photographs for them, or like do you see what I'm saying?
Yes, sir.
It's like doing something with the hope of something good coming out of it.
Yes, sir.
Right. So I don't know. Have you done anything in the past where, as a photographer, you've had to take a risk? So you did something unconventional, something different, and something good came out of it, not something bad.
Gee whiz.
See, now my question
Well, I mean,
to you is, when you were
some of my
thinking
first
about
bigger.
that, were you thinking about it as being an opportunity, or were you thinking about it as
Yes.
being a risk? You were probably thinking about it as being a risk. Because
Yes,
do you
sir.
agree an opportunity is only something that we would be able to look back on? So now, if you do something that's risky, and if the outcome is good, then looking back on it, you're probably going to say, well, that was an opportunity, that wasn't a risk. Because we can then look back on
Okay.
it.
Yes, sir. Yes, I
Do you
see.
agree? But now the thing is, at that moment in time,
Yes,
when you were deciding whether to do it or not, you didn't know it was an opportunity. You didn't know it was a risk. So that's why I say I don't want you to think about the word risk as being good or bad. The word risk just means uncertainty.
Yes, sir.
No one knows what's going to happen.
Yes, sir.
Okay, when we do things, so when we take risks, and those risks pay off big time, and those risks are actually good, then we normally call them, well, that was a good opportunity. That makes sense.
Yes, sir.
Okay, but it's just the language. The language isn't that important. It's more the concepts. So remember, we're looking at the risk management. So we're looking more at ability to reduce risk, or the ability to manage risk. Okay, so coming back to the question,
Yes, sir.
did you take any risk recently or in the past that actually paid off, and something positive came out of it?
Um, oh yes. Well, this year, I took the at my house, right? So I've got like a small studio that I usually do my personal work from. So it's got a backdrop, it's got lights, it's got everything. It's not the one that I use. Yes, at my house. So it's like it's in the backyard. It's in a room in the backyard. It's not the one that I use for like bigger corporate clients and stuff like that. But it's one that I use for everyday kind of people.
Okay, so what happened? What did you do? What was the risk?
So earlier this year, I opened it up for rental. Like people can just come and rent and use it whenever they want to use it and take their time, and especially people who cannot afford to rent out a professional studio.
Yes.
For like 1,500 an hour and stuff like that.
Okay, so my question to you was that a risk?
Yes, so because
it was.
Because yes, sir.
Okay, so what happened?
Well, through that, I wasn't sure that people would actually buy into the whole thing, because I was just putting it out there, but people started really renting it out, and then through that I made some connections, and some lady who does these like incubator session type of things with upcoming with young business owners. And through that, I got an opportunity to shoot for her company, which was working with MultiChoice when they were doing these, like I said, these incubator weeks and sessions and stuff like that. And that's how a risk that I took led to a good opportunity, or to something great happening.
Yeah, exactly. So do you agree? At that point in time, you never viewed that as being good or bad. You just viewed it as being something uncertain, right?
Yes, sir.
Okay, so you were going to just like go with this, and you were going to put it out there and see what actually happens, right?
Yes, sir.
Okay, and then fortunately something good came out of it rather than something bad.
Yes,
Okay,
sir.
so now obviously you're looking back on this and you're saying, well, that was an opportunity, not a risk, right? But it was a risk. You took a risk. It just paid off positively, not negatively.
Yes,
But
sir.
it was still a risk, though.
Yes, sir.
Okay. Right, so that's what they're trying to look at here. Okay, so uncertainty means we don't know what's going to happen, right?
Yes, sir.
Okay, should we have an idea, though?
Yes, sir.
Should we have an expectation?
Yes, a calculated risk.
Yeah, so you're talking about a calculated risk. That's good. Okay, because now we're actually thinking about the risk that we take. We're not just doing things blindly or without having thought about it.
Yes, sir.
Okay, that's good. Okay, so why incur risks? Well, there's the diagram. Gaining competitive advantage, increasing financial return. Okay, so as a business, is a business going to grow if the business doesn't take risk?
No, it won't, sir.
No, definitely not. So risk provides opportunity. Okay, so risk itself is opportunity. Opportunity could either be good or bad in terms of good opportunities or bad opportunities. Because you also get both. You can get good and bad opportunities, right?
Yes, sir.
Okay, so risk is looking at that potential reward. Okay, it's potential because it isn't guaranteed.
No, sir.
No, it's not guaranteed. Okay, no one knows what's going to happen. Right, but you have to do, how can I say? You have to test it out. You need to try. Okay, if you don't try, you won't know, and that's why that's a risk. Okay, so for
Yes, sir.
example, you thought about renting out the studio. You didn't know if it was going to work or if it wasn't going to work, right?
Yes, sir.
But you were willing to take the risk.
Yes.
Okay, you were willing to test it, to see, well, what was going to happen. Okay, now you can look back and you can say, well, that was a good decision. Okay, but remember, you probably weighed up the pros and cons before you did it, right?
Yes, sir.
Okay, you probably thought, well, okay, it's somewhere away from the house. It's a room away from the house. So in terms of safety, it's not a big issue. People aren't coming to the main, let's say, property. It's off-site, so security
Yes.
risk might not be as high. Doesn't that make sense?
Yes, sir.
Okay, versus if this was actually like in the main house, and now you're renting it out to outside people that are going to literally walk around the house, the property. Okay, so do you agree the
Yes,
risk
sir.
there might be higher than if the studio was separate?
Yes, sir.
Okay. Right, then they talk about some activities here. This is just theory looking at the concepts of risk and return. Let's have a look at the theory here. There we go. Where are risks relevant? So in other words, what risks do we get?
Oh, you're asking me, sir?
Yeah.
Sorry. Oh, sorry. We can get a financial risk. We could get, I suppose you could say physical risk, which could perhaps entail either your physical body or your physical things. We could get.
For a business?
Sorry, sir?
For a business?
What kind of a risk?
Yeah, for a business.
Well, we could have financial for business. We could also have, I suppose, structural risks in the sense that
operational, not structural, maybe operational. So like
operational. Yes.
Yeah. Okay, so doing certain things differently.
Yes, sir.
That's a risk. It could be better, or it could also be worse.
Yes. What are the risks? We could have legal risks, perhaps.
Yeah, so some things you can do, some things you can't do.
Yes, sir. I suppose. What's the risk of not being able to? Reputational risk? Yes.
Yeah, reputational risk.
Does the risk of not being able to pay your creditors also fall under financial?
Credit risk, that's fine.
Okay, credit risk.
Yeah, that's definitely something that you could consider.
Risk
or default
of
risk even. Credit risk, default risk.
Risk of damagement of property in some way.
Yeah, so damage of property, maybe environmental risk.
Environmental.
So hail.
Yes.
We've had some hectic storms recently. That could be an environmental risk.
Yes. So fraud and corruption.
Yeah, that could be more. What could we look at that? That would be maybe a business risk in terms of fraud and corruption. Yeah.
Yeah.
Okay, so there's a lot of different risks. Risks can be grouped into different areas. So here they're just looking at where are risks relevant. So they're looking at areas of the business.
Yes, sir.
Okay, so is there risk in the accounting department?
Yes, there could be.
There could be. Okay, so the accountant's not following the rules. Okay, could there be risks in the financial markets?
Yes, sir.
Yes, they could. Okay, so we might have a recession. Okay, we might have a natural disaster. We might have war. Okay, so one country fighting with another country creates risk in the markets. Okay, management accounting is internal. So see, financial would be external risks.
Yes, sir.
Management would be internal risks.
Yes, sir.
Okay, so can the manager steal from the business?
Yes, they
possibly. Okay, could there be accounting risk? Yes.
That's KPMG.
Okay, so yeah, fluctuating commodity prices, interest rates, exchange rate, there's a risk. Okay, that would be more external than internal though. Okay, so risks are everywhere. Okay, so when talking about where are risks relevant, risks are relevant in all areas. Okay, all areas have a certain level of risk.
Yes, sir.
All areas have risk. They just have different risks. Okay, and remember, risks are good and bad. Okay, it's not only the bad.
Yes, sir.
Okay, so in certain areas we can have good things happening, we can also have bad things happening. Right, then they talk about the strategy. So in terms of the strategy, what should we be doing to reduce risks?
Should be planning better.
Okay, so planning is a way to reduce risk. Okay, so that would be the thinking before the doing.
Yes, sir.
All right. So here they talk about the purpose. Okay, so if I'm looking at objective, obviously objective is to do what?
Create value.
Create value by doing what?
By
maximizing return, minimizing
expenses,
risk. Okay, so when we had this diagram over here, do you agree? We want this diagram to be as steep as possible, right?
Yes, sir.
Okay, meaning we get the most return with the least amount of risk.
For the list risk.
Okay, versus this.
Yes, sir.
Okay, which line is better? Obviously, this one would be better, right?
Yes, sir.
Okay, so I take on more, or I get more return, and I don't have to risk as much. Okay, versus this one, I have to risk a lot, and I'm only going to get a very small return. Do you see the difference?
Sir. Yes, sir.
Okay, so when looking at risk management, you're trying to minimize the risk as much as possible and maximize the return as much as possible. Okay, so here they talk about risk appetite, risk tolerance. Is that important? Very. Okay, you've got three different considerations here: risk adverse, risk neutral, and risk seeking. Risk profile. Okay, so if we're looking at these three, risk seeking, good or bad idea?
Bad idea.
Bad idea. Why? Because this is looking at taking risks for the thrill of it.
Yes, sir.
Okay, so that's looking at being reckless. Okay, that's not what financial managers should be doing. Okay, if you're risk seeking, okay, you're looking for risk. Right, you're not considering the return. You just want more risk just for the sake of wanting more risk because of the rush, the adrenaline rush, or whatever the case might be. Okay,
yes,
risk
sir.
neutral is not placing enough emphasis on risk, meaning not caring enough about it. Okay, you should care about risk because we know risk is something that we need to manage. Okay, so if we're neutral, we don't really place that much emphasis on it. Okay, whether something's risky or not, we don't really bother. Okay, it doesn't matter.
Yes, sir.
It should matter. Okay, risk adverse, this is the best view for financial management or investment management or anything in terms of decision making, risk adverse.
Yes, sir.
I'm going to say for decision making. Okay, so this would be weighing up pros versus the cons. Always seeking more return if more risk is taken. Okay, so let me ask you this. When you decided to rent out the studio, were the pros
Yes,
more than the cons?
Yes, sir.
Yes, they were. And that's why you did it. If the cons were more than the pros, would you have still rented out the studio?
No, sir.
No, you wouldn't have. Okay, because then you would have been seeking risk. Do you agree? You would have been reckless.
Yes, sir.
Okay, so when looking at risk adverse, this is the best risk profile for decision making. Okay, meaning if I choose to take on more risk, I want the reward to be greater because it justifies taking the risk. Does that make sense?
Yes, sir.
Okay, there's no point taking a risk if there's no upside, or if the upside doesn't justify taking the risk. If that makes sense.
Yes, sir.
Okay. Right, so they talk about risk culture, which is the attitudes that people have around risk. So let me ask you this. Are you risk adverse? Or let me ask you this rather. Are you, in terms of your risk profile, what view do you have? What culture do you have? Are you aggressive? Conservative? Or more moderate? What's your view on risk?
I'd say conservative to moderate, but more conservative.
Okay, so why do you give that answer? What makes you say that?
Well, I think it has to be, for me to go for something, I have to be almost not 100% sure, but considerably sure that the return that I'll get will match whatever risk that I've taken. So I'm not someone who jumps at any opportunity without looking at it first and considering it, asking for second opinions, sleeping on it, and then after that thinking, okay, this could really be something worth going for.
Okay. All right, good. So you've identified the culture as being more conservative.
Yes, sir.
Okay. In terms of risk capacity, that's looking at what's the maximum amount of risk that you could actually accept, that you could take on. Right, so why do you think you're more conservative? It's probably because, in terms of risk capacity, you don't want to lose too much, right?
Yes, sir.
Okay, so it's because we don't want to lose too much, that's why we're more careful.
Yes, sir.
Okay, and that's always the case. So if we have more to lose, we can take more risks.
Yes, sir.
Okay, if we don't have as much to lose, then we're going to be very careful when we take risks. Do you agree?
Yes, sir.
Okay, and that kind of affects your risk culture. Okay, so the capacity to take on risk generally determines your culture. Okay, your profile, your attitude. Okay, so are you more high risk? Are you more low risk? Right, so again, businesses need to establish that. Okay, businesses would either take more risk or less risk. So let me ask you this. What type of business are more risk takers? Startups or more established businesses?
I think more established businesses, because they have the capacity to take those risks.
Okay, true, they have the capacity to take on more risk, but at the same time, do they take on more risks?
Oh, big businesses?
Yes. No, they don't. Why not? Because they have more to lose.
Yes, okay.
Okay,
yes.
So the risk capacity also looks at the extent of loss.
Yes, sir.
Okay, so if you have nothing to lose, would you take on more risk?
Yes, sir.
You could. Okay, so see, it could work both ways.
Yeah.
Right, so risk capacity could mean, well, you have more resources, you could take on more risk. Do you agree?
Yes. Yes, sir.
But if you've got more resources to take on more risk, you also have more to lose. Does that make sense?
Yes, sir.
Okay, so a company that has more resources, depending on their risk culture, they're either going to take on more risk or less risk, depending on what's their priority, what's their goal.
Yes,
Do you agree?
Sir. Yes.
Okay, so for example, let's say you had one company that had lots of resources, but they were very conservative. Do you think they're going to take lots of risk?
They had more resources, but
they're very conservative.
Would they take more risk?
Would they? No, they wouldn't, because they're conservative. Does that make sense?
Yes, sir.
Okay,
Yes.
versus a business that's aggressive but lots of resources. They would probably take more risks. Do you agree?
Yes, sir.
Okay, so capacity could work both ways. You could either have nothing to lose and then you take on so much risk, or you could have more resources that allows you to take on more risk. So both options are possible.
Yes, sir.
Okay, it's looking at the maximum amount of risk that you're willing to accept. That's what you're looking at. Got that?
Yes, sir.
Okay, board of directors, those are the people that decide and make decisions. Okay, definition of risk management, we've spoken about it before. It's ways of reducing risk. It's ways of managing risk. It's basically looking at weighing up the pros and cons. Okay, decisions have consequences. Right, so managing risk is understanding what the decisions involve. Okay, so if we do something, what is the possible consequence? Okay, that's risk management. Risk management is thinking before you do something, right?
Yes, sir.
Okay, not having risk management is just doing things for the sake of doing things. Okay, there's a big difference, right?
Yes, sir.
Okay, so here you're looking at definitions of risk management. The first, risk management is the process of reducing risks. Okay, we know that. We know we need to reduce risk and maximize return. SEMA defines risk management as the process of understanding. See, there's the key. Okay, do you know what the consequences are going to be? Right, then you've got the Committee of Sponsoring Organizations on the Treadway Commission. Okay, it defines enterprise risk management as this: a process affected by the organizational board of directors, management, and other personnel applied in strategy. See, what are we going to do? Okay, the process is designed to identify potential events that may affect the organization, to manage risk within the organization's risk appetite, and to provide reasonable assurance regarding the achievement of the organization's objectives. Okay, so that's looking at strategy and looking at events and looking at consequences. Okay, objectives. If we do certain things, what's the impact going to be? Okay, so do you agree that risk management means a different thing for different people, right?
Yes, sir.
Okay, so when I talk about risk management, risks are very unique because every business will have a certain level of risk. Okay, there's no one definition for it. Okay, we can talk about risk relating to a photographer, okay, and those risks will be very different than risks affecting a doctor, let's say.
Yes, sir.
Okay, or a different industry. Okay. Alright, then they talk about the risk management process, risk identification, risk assessment, responses or mitigation. Okay, this is not the best risk management process. I've seen better. Okay, this is just 3 categories where they talk about risk management in terms of a process. In the actual risk module, so the RSK modules from UNISA, they give slightly better diagrams there than they do in this module. Obviously, because this module's focus isn't on risk specifically, it's just additional to the management accounting, okay, to the management of a company. Okay,
yes,
so
sir.
You will see better diagrams in other modules, okay, in other textbooks as well. In this particular textbook, they just talk about these areas. Okay, risk identification, assessment, response, and financing. Identification, do you need to know what the risks are?
Yes, sir.
Yes, okay, so risk identification is looking at trying to identify what the risks are before deciding on whether they're risks that you need to actually consider or not consider. Manage process. Okay, so number 1 is to identify. Okay, so identify means what are the risks? Okay, are you going to manage all risks?
Well, you can try, but some might not be in your control.
Possibly, but also it's impossible to manage all risks. Some risks you just have to live with, right?
Yes, sir.
Okay, so risk assessment is how worried are we about the risk. Okay, so here's the example. We spoke about driving. Okay, if we were so worried about being in an accident, do you agree that risk assessment would then say, well, being in an accident is just too bad, so we'll never ever get into a car, we'll never ever drive. Do you agree?
Yes.
Okay, risk assessment could be, well, okay, yes, we can be in an accident, okay, but cars have safety precautions in place, safety, what can I call it? Safety features that prevent, let's say, death in the event of an accident. Okay, so we might say, well, okay, yes, we've identified being in a car accident as being a risk, but we're not that worried about being in an accident and dying because the cars are more safe.
Yes, sir.
Right. So that's something like identifying a risk. Skydiving. Okay, what's the risk of skydiving?
Well, your parachute might not engage.
The parachute might fail. Okay, so if that's a risk, there could be a backup, right?
Yes, sir.
Okay, so the risk assessment, how worried are we about the risk? So if we're worried about the parachute failing, then we would have a backup parachute.
Yes, sir.
Okay, so obviously the risk assessment is going to determine, okay, whether we actually take action or not. Okay, and if we're so worried about the parachute not opening, then we're not going to even skydive at all. Okay, that's the risk assessment. So the identification is, well, what is it? and the assessment is it something severe enough? They talk about severity. Okay, that's something to consider, severity. Is this something that's going to put your business out of business? Or is this something that the business can sustain? Okay, it's like, for example, okay, you've got cameras and all of that. So do you insure your equipment?
Yes, sir.
You do. Why do you insure your equipment?
Well, in the event of loss, theft, damage.
Yes. Okay, so for you as an individual, because you're running a business, your equipment is very valuable, right?
Yes, sir.
And that's why you choose to insure it. Do you agree?
Yes, sir.
Okay, but for someone who's not using the camera to run a business, would someone insure that camera?
No, sir.
No, they probably wouldn't. Okay, so people that go on holiday and take a camera on holiday, they're not going to insure that camera. They might, but again, that depends on their risk assessment. Do you agree?
Yes,
you see, it's identifying the risk and then determining its severity. Okay, how severe is the loss? Is the loss going to put you out of business? Well, for a photographer, losing all your equipment is going to put you out of business. That's why we've assessed the risk as being important in order to prevent it from happening.
Yes.
Okay. Risk response is, what do we do? Okay, so do we take out insurance? Okay, do we need to be more careful? Right, those are measures that we need to do in terms of approaching risk. Okay, doing something about it. Right, financing is looking at trying to use resources or money to solve those problems. Okay, so risk financing is when we take out insurance. That would be risk financing. Okay, so risk response / financing. Okay, what do we do? Okay, sometimes you don't have to spend money to reduce risk. Okay, something as simple as, like, let's talk about computers. Okay,
yes,
normally computers, let's say if you're working for a company, do you think you're going to have to change your password every few months or every few weeks?
Well, yeah, so just to make sure that no one gains access into your information.
Exactly. Okay, so for companies, they put certain safeguards in place. Right, asking the user to change their password doesn't cost the company any money. Do you agree?
Yes, sir.
Okay, it's just something that's included as a form of control. Okay, other textbooks talk about risk control rather than risk response. Okay, so how do you control the risk? And then financing is looking at spending money, okay, to prevent bad things from happening. Okay, so risk financing could be taking out insurance for fraud. Okay, so if someone accesses our computer systems as like hacking, okay, then an insurance policy might cover the loss that could be sustained. See, that's financing. That's throwing money at the problem to solve the problem. Risk control is to try to fix the source of the problem. Okay, so if the source of the problem is unauthorized access or people knowing what passwords are, then you would solve that problem by asking people to change the passwords.
Yes, sir.
Okay. Right, then they talk about why risk management. Then they look at the King 3. Okay, you've probably covered King 3 in auditing.
Yes, sir.
Okay, what is King 3 looking at? Corporate governance, right?
Yes, sir.
Okay. So why is that important from a risk management point of view?
Well, I think it's important because corporate governance basically looks at how a business conducts itself.
Correct.
Across in the business world, so to say. So I think how that relates is also because in King 3, a business is required to have like an audit committee, a risk and audit committee.
Correct.
And all these other committees. So I think it's basically to be able to manage the risk of the business even better, to become the best corporate citizen possible that they can be.
Exactly. Yeah, because remember, what are companies actually required to do? Make a profit, right?
Yes, sir.
Okay, because remember, companies are accountable to the shareholders, right?
Yes, sir.
And we know that shareholders are wanting a profit. Okay, so
Yes,
what's
sir.
stopping a company from acting unethically? Nothing really.
Yes.
Okay, the only thing that actually prevents a company from doing the wrong thing is the rules and laws of a specific country.
Yes.
Okay, because remember, companies are required to generate a return because they're accountable to shareholders. Right, so
Yes,
if it
sir.
wasn't for legislation, if it wasn't for good corporate governance, those companies would be willing to do questionable things in order just to generate more profits. And that's
Yes, sir.
bad. Okay, and that's why we have rules and laws to help protect people, citizens, society at large. Okay, so
Yes,
they talk
sir.
a little about King 3 there, and they talk about the objective. Okay, the objective we know is to maximize value, but sustainable value. See that now they've brought in a new word, sustainable. Right, is it possible to maximize value that's not sustainable?
Yes, sir.
Yes, what is that? That's stealing, right?
Yes, sir.
Okay, stealing is maximizing value, but it's doing it unethically. Do you agree?
Yes,
Is
sir.
stealing sustainable?
No.
No, it's not. Okay, because at some point in time, the company is going to fail. Right,
Yes,
so
sir.
the objective of risk management is to try keep the business going, but for the long term. Okay, achieving those long-term goals. So what does it involve? It looks at addressing all those opportunities and those threats.
Yes,
Okay,
sir.
increasing the probability of success. Right, it's looking at the positive. It's looking at that long-term value proposition. Okay, so long-term value versus short-term gain. Okay, so a business could maximize value in the short term by doing certain unethical things.
Yes,
Okay,
sir.
but if the business wants to be sustainable, right, they need to be looking at the long term. Right, it's like pollution and like resources. So, for example, like let's think about an example. Oh, there was one not so long ago. I think it might even be current news as well. They talk about like fracking. They're looking for gas in the Karoo. I don't know if you heard of that. Fracking. They call it fracking. Right.
Yes, sir.
It's a process of finding natural gas in the Karoo. Okay, and obviously it's going to harm the environment.
Yes, sir.
Okay, so certain people are against it, certain people are for it. Okay, because they're looking at making more energy. Right, so obviously if there weren't any rules in place, companies would be willing to do anything in order to make a profit. So they would harm the environment in order to make a profit. Okay, but if they're
Yes.
sustainable, they wouldn't. They would think about their actions before they do it, if that makes sense.
Yes, sir.
Okay, and that's looking at the objective. Okay, risk management. It's sustainable value. That's the key. Sustainable means it's going to last forever. It's going to last a long time. It's not short-term gain.
Yes, sir.
Okay, then they talk about some of the benefits of effective risk management. Obviously, we need to align the risk appetite to the business strategy. Remember, different businesses have different profiles. Some businesses are more aggressive. Some businesses are more conservative.
Yes, sir.
Requirements, okay, that's just looking at what do we need. Okay, what do we need in order to have good risk management? Right, so the most important thing here is definitely resources. Okay, so management's commitment, integration with planning processes, common language and framework, acceptance. Okay, everyone needs to buy into the process. Right, the whole company needs to buy into the process. And also, who manages risks? Does the whole company manage risk or does a department manage risk?
So sorry, sir.
Who manages the risk?
I think management. Shouldn't
No,
management-
it's everybody.
Oh,
Do you agree?
yes, sir.
Okay, because at all levels, employees should focus on reducing risk as much as possible. Okay, because think about it. Different people at different levels would be able to identify different risks.
Yes, sir.
Okay, so let's say managers would be more inclined to look at higher level risks. So they might be looking at things like risks in terms of strategy. So if the company chooses to do this, it's going to create a certain risk. Right, people on the ground, okay, the employees, those are the people that actually are actively doing the work, and they're more capable of identifying more operational risks. So things that they're doing currently that create problems, that create negative things. Does that make sense?
Yes, sir.
Okay, so for example, as a photographer, if we think about different levels. Okay, so if you were a photographer for a magazine company, okay, so you were employed by a newspaper or a magazine.
Yes, sir.
All right? Would you be able to identify risks at a company level? Probably not, right?
Yeah.
Okay,
yes,
because you wouldn't be on the board of directors, let's say.
Yes.
Okay, but would you be able to identify risks at a operational level?
Yes, sir.
Yes, you would. Okay, you might be able to suggest certain improvements at your particular level if that was the scenario.
Yes, sir.
Okay. Right, and I think that's it, yeah, that's it. And then there's a summary here just in terms of the risk. Okay, so just remember, risk is not good or bad. Okay, risk is actually both. It's just looking at this. See, in the self-assessment activity, they talk about this, the relationship between risk and return. Okay, so let's quickly run through these just to end off. You tell me, what is the relationship between risk and return?
Well, the more risk that we take, we're hoping to get a higher return, or the more risk we incur, the higher we are hoping that the return will be.
Good. So the risk should justify the return.
Yes, sir.
Okay, so with more risk comes more return. Okay, it doesn't matter which way the graph is. It could be this way, return here and risk there. It's the same thing. Okay, when I increase the one, I need to increase the other.
Yes, sir.
Okay, define what risk is. What is the concept?
Well, the concept of risk is basically uncertainty, and so can you hear me?
Yes.
Okay, yes. Uncertainty. I want to go back to what I said. Not knowing what lies ahead, but taking calculated steps that will hopefully bring about a greater return.
Yes. Okay, that's good. So definitely uncertainty, not knowing what's going to happen, and managing or identifying potential risk. Okay, what is the culture?
Well, the culture, it's how you approach risk, or the attitude you have towards it. So you could be conservative, or you could be, I suppose, reckless in a way.
Yeah, so the attitude would be, what's your view? So as you said, being more reckless or being more conservative. And your appetite would be?
How much risk you take on.
Exactly. So how much are we willing to take?
Yes.
Right, because as you said, you get different levels of risk, moderate, low, high, depending on what we've got.
Yes.
Okay. All right, and then 3 categories of risk appetite. That's easy, right? We spoke about them. Risk seeking, risk neutral,
risk adverse,
risk adverse.
Yes, sir.
Okay, that relates to appetite. All right, and I think that's it, yeah. Okay, that's where we'll stop tonight. All right, so we've literally got, I think it's 2 more longer chapters. Again, it's theory, and then we've got those last 3 short chapters, and that wraps up the theory. So we will complete the theory next week. At least then we've covered all of that, and then we'll start with past papers in November. So at least then we'll have 3 complete weeks of past papers.
Yes, sir.
Okay. All right. Any other questions? Are you happy?
No, I'm good, sir. Thank you.
That's great.